Picture this. It's 1985. You've just started putting your money into the market. Every month, you check your balance, and it's slowly climbing. You feel smart. Your money is compounding, and the environment feels perfectly safe. Then, Black Monday hits. Wall Street experiences the largest single-day percentage drop in its history. In a matter of hours, a massive chunk of your portfolio is wiped out. The media immediately screams at you. Your friends and colleagues are begging you to pull whatever you have left out of the market to avoid total ruin. But instead of calling your broker to liquidate, you do something incredibly difficult. You do nothing. You sit on your hands and you wait. Market crashes don't actually destroy your wealth unless you sell. It is the human instinct to give in to terror at the absolute bottom that permanently locks in the loss. A decade later, the market tests you again, but this time with greed. It's the late 90s, and internet companies with zero profits are minted overnight. The prevailing promise is endless, effortless wealth. Then the music stops. The tech-heavy indices go into freefall, dropping nearly 10% in a blindingly fast cascade. The paper fortunes everyone bragged about evaporate. The exact same crowd that was euphoric just weeks earlier abruptly reverses course. The noise around you is deafening, demanding that you abandon ship before technology stocks collapse entirely. Technological hype is a temporary phenomenon. Long-term financial survival belongs exclusively to the people who can block out that noise, stick to their strategy, and hold the line. Eventually, you arrive at 2008. The global economy contracts by 3%, the worst downturn since the Great Depression. Banks are failing, homes are foreclosed. There is a very real, visceral feeling spreading across the country that capitalism itself might actually be ending. This chart shows the depth of that despair, followed by the immediate aftermath. When the system reopens, the market soars 27% from its lowest point, setting entirely new records. A recession pushes asset prices down to levels that would have been unimaginable months earlier. These periods of peak pessimism offer the most significant returns for those with the patience to wait for the eventual recovery. Many people try to survive these volatile cycles by day trading. They exhaust themselves staring at monitors, trying to predict short-term price movements and outsmart the daily chaos. But there is an alternative. Fundamental investing ignores the daily guessing game completely. Instead of trading, you purchase an index fund, a single asset that gives you a tiny slice of the entire market. Think of a broad index fund, like the S&P 500, as the music charts. The top-performing companies rise to the top. If a business does poorly, it gets pushed off the list, and a growing company takes its place. This auto-cleansing mechanism protects your core wealth. The broader market absorbs individual failures and continues to trend upward over time. Trying to day trade through crashes is like trying to forecast the weather. Buying the whole market is how you build a ship that cannot sink. Let's pull back and look at that entire timeline. Imagine you started in 1985, and all you did was invest a modest $250 every single month. This chart shows the long-term historical average return of 11.23% per year. When you combine that rate with those steady monthly deposits, the math starts to do the heavy lifting. Notice what happens here. Black Monday, the dot-com burst, and the 2008 collapse hit the timeline, but they become tiny micro-deps. By staying invested, that monthly deposit compounds into a staggering $1.84 million. The math proves that the duration of your investment is a more reliable driver of wealth than picking the right stock. Simply accumulating time generates more growth than hunting for a moonshot. If you suffer from paralysis, waiting for the perfectly safe moment to put your money to work, you will be waiting forever. History proves that moment never arrives. Set up an automatic transfer from your bank account to an index fund on Payday. This removes human emotion from the equation entirely, forcing you to buy the market whether the news is good or bad. Significant wealth is captured during the inevitable recoveries that follow these periods of extreme stress. Automate your future, own the market, and let the cycle work in your favor.